Um,
This
This will
meeting
be
is being
recorded, so
recorded.
we'll be recording the webinar here today. And if anyone has questions, I'll take questions at the end when we're wrapped up here. And then I will send out this web recording to help as well. So I'll go ahead and jump right in. We're a couple minutes past 12, so hopefully everyone that is joining the call has had plenty of time to do so. So what we'll talk about today is tax planning, both while you're working and then into retirement. So a lot of the times where what people think about when they're working is save as much money as we can, knowing that later on in retirement, you may not have won't have a salary and your income will potentially be lower. Therefore, your taxes should be lower. But from everything that we've seen that's going on, with the national debt that we've seen and tax rates being at a historically low rate, it's not guaranteed that the tax rates we see today you'll see later on into the future. So a lot of people are anticipating we will see some tax hikes. The current tax bracket that we are in is due to sunset in 2026. So that could have an effect on personal income tax brackets. So quick disclosure as we get started here, this is for informational and educational purposes only. Do not treat this as specific tax advice. It's more so just speaking in general. Obviously, you can consult with me or consult with a tax advisor before you make any decisions based on this presentation. So a couple of things what we'll talk about today. So we will talk about reducing your taxes through retirement investing, ways to reduce taxable income, especially in retirement, setting up tax advantaged income in retirement, maximizing your Social Security benefits. And then also from a tax planning standpoint, a couple of things to consider would be the timing of your income, and also within your accounts, what types of investments work well with certain types of accounts. We'll touch on the current tax law and other topics as well. So first and foremost, what everyone is probably most familiar with is the way to reduce your current taxable income through your retirement savings. So if you're employed and your company is offering you a 401k plan, they may be offering a 403b. Those accounts are set up directly through your employer. They come directly out of your paycheck and you save into those accounts with pre-tax dollars. I know that a lot of plans now offer a Roth 401k. We'll talk about Roth here in a minute, but just assuming for right now, pre-tax dollars going into your 401k plan or 403b. The other thing to consider is when your company matches those dollars, the company match goes in as pre-tax money as well. So 401k plans are probably what people are most familiar with. The benefit that you get in the year that you make that contribution is that immediately it's a dollar for dollar reduction of your taxable income. So for easy number purposes, if you make $100,000 in earned income, you save 10% of that into your 401k. The IRS views that and only taxes you on $90,000 of your income. So for your 401k plan for 2022, they actually increased your maximum contribution. So you could save as much as $20,500 into your 401k. If you're over the age of 50, you get the additional $6,500 catch-up contribution. So you could save as high as $27,000 if you're over the age of 50. And again, this decreases your taxable income in the current year. So it is a way that you can, it's one of the easiest ways where you can reduce your taxable income for the year. Keep in mind, if you're self-employed, there are benefits, there are retirement plans where you can take advantage of as well on a pre-tax basis. So a SEP IRA, a simple IRA, or a traditional IRA are all ways that you can save money towards retirement on a pre-tax basis and lower your taxable income for that year. So one thing to consider of what meets the definition for self-employed. So it doesn't necessarily have to mean that you own your own business. You could be a 1099 employee, you could be an independent contractor, and you could still set up a SEP IRA. So a SEP stands for a self-employed person IRA. What that does is if you have any sort of income that you're getting 1099 on, or like I said, independent contractor, you can contribute into these accounts. Maximum contribution would be 25% of your compensation up to $61,000. If you're working with a group of people and it's a small business and you don't necessarily want the extra burden of a 401k plan, you could set up a simple IRA. These are easy to administer. They can be set up at different brokerage firms, and the contribution limits for that, if you're under the age of 50, would be $14,000. And if you're over the age of 50, you get that additional $3,000 catch up as well. And then the traditional IRA, that can be, for anyone that is working that is not offered a 401k plan through their employer. They can put $6,000 into a traditional IRA. If you're over 50, you have that additional $1,000 that you could put in for a maximum of $7,000. And again, those are all treated as pre-tax dollars. So another way that you could potentially reduce your income in the current year and things to take advantage of would be through a health savings account or a flexible spending account if your employer offers those. So in order to be eligible for a health savings account, you have to be in the high deductible healthcare plan. And if you are married, filing jointly, and you're under a family coverage for your health insurance, you can put as much as $7,100 into a health savings account. Flexible spending account is a little bit different. You have to predetermine which amount that you want to put in, but you do get a tax deduction on those flexible spending accounts as well. Health savings accounts, you can roll those forward year after year, just like you would with a normal retirement account. With a flexible spending account, they make you spend that money down every year. I believe there's about a $500 that you can roll over into the next year. But that is another way through your health savings account that you can potentially lower your income in the current year. That $7,100 would be in addition to any 401k contributions you're making or any IRA contributions that you're making as well. Also to note, health savings account is triple tax advantaged. So you get a deduction for the money that you put into there. If you invest the money in your HSA, that money grows tax-free. And then when you take that out, as long as you spend it towards medical expenses, you do not pay taxes at the time that you withdraw it. So HSAs are a great advantage, something to take advantage of. And then another way for you to potentially experience some tax savings would be through a 529 account. So a 529 account, as long as you open it up, I know most of the callers today live in the state of Ohio. So if you live in the state of Ohio and you open up a state of Ohio 529 plan through the College Advantage site, you receive a state tax deduction. It's a deduction of about 25% of your contribution into that 529 savings account. A couple of benefits there with the education savings account with the 529s. You can now spend on tuition from K through 12, as well as college. So you can do grade school, high school, and also college. The money you put into that account, like I said, you do receive a small state tax deduction on those contributions. That money grows, it can be invested. And then as long as you take that money and you use it towards education, the earnings that you have in that account are tax-free to you. So another advantage would be taking another account that you could be taking advantage of. You could potentially pay for your child's tuition all through tax-free earnings. So something to keep in mind, a couple of tax advantages there. So one of the things that I wanted to get into today as well is the different tax buckets and the different types of accounts and how those accounts are all taxed. So if you were to fast forward and look at retirement, these are the different sources of retirement income that you can come up with. So source number one would be Social Security. You've got your 401ks and pre-tax IRAs, a Roth IRA, pension plans for those that still have those. If you're maybe a city or government employee or a teacher, you may still have a pension, or if you're lucky enough that your company still offers a pension, you could have pension income. And then you also have taxable investment accounts. So these are normal brokerage or investment accounts that you have that may be invested in stocks or bonds. It's money that's already been taxed that you've put into an account. All of these different sources are taxed in different ways. So Social Security, if you're below certain income thresholds, you may not pay any taxes on your Social Security. If you're married filing jointly and your income is between $32,000 and $44,000, you may pay 50%. 50% of your Social Security may be taxed. If you're above $44,000 for a married couple, you may pay as much as 85% of your Social Security may be taxable to you. 401k plans, we talked about these earlier. Every dollar that you take out of your 401k plan or a rollover IRA in retirement, that gets added to your ordinary income. So that's essentially taxed at the highest tax rate, is what you see from your 401k or IRA. Roth IRA, these are great to have. Earnings accumulate in your Roth IRA. You contribute after-tax money into a Roth IRA or a Roth 401k. That money grows, it's tax deferred. And as long as you take that money out, if the Roth has been open for 5 years and you're over 59 and a half, you can take the earnings out of that account completely tax-free to you. Pension plans, those are taxed as ordinary income once you do receive those. And then taxable investment accounts. So these are taxed at capital gains rates. So for taxable investment accounts, I'll talk a little bit more about these later, but they're a great tool to have in retirement because they're taxed in a different way than your 401ks and IRAs and your Social Security would be taxed. And they are very tax advantageous as long as you have, dividends and capital gains rates in those taxable accounts. So I briefly ran through kind of the tax consequences for each one of these. Like I said, traditional IRA, you're taxed at ordinary income tax levels. Same with traditional 401ks. Roth IRA, you have the opportunity to have those be tax-free. Pension payments, again, those get added to your ordinary income and you're taxed at those in that ordinary income tax rate. So taxable investment accounts. So many of you've probably heard of Warren Buffett, right? Warren Buffett is deemed as possibly the greatest investor of all time. Warren Buffett has come out and said that he pays less in taxes than his secretary, right? Warren Buffett, who has an $80 billion net worth, roughly, give or take, says that he pays lower in taxes than his secretary does, who earns a salary. So how could that be, right? How could that possibly be? Well, he has money that's saved in taxable investment accounts that has long-term capital gains, or they pay a great dividend. He likes companies that pay a great dividend. Procter & Gamble, Coca-Cola are two of his large holdings. Those companies pay a good dividend. He can collect that dividend as income and only pay, for Warren, either 0%, 15%, or the maximum capital gains rate, which would be 20%. So if he's taking dividends from his investments, could only be paying a 20% tax rate. Whereas if his secretary is potentially making $200,000, she could be paying as high as 24, maybe even 32% in taxes at her tax rate. So taxable investment accounts are a great bucket of money so that you can have tax diversification in retirement because it's taxed at capital gains rates. If you've got Roth IRA money, that money's tax-free. And then if you have 401k or rollover IRA money, that's taxed as ordinary income. So it's a good way to have what I call tax diversification when you enter retirement. Another key thing to keep in mind for people that may be working throughout their career and your company offers you employee stock purchase plans, or if you work for an employee and they gift you stock or grant you stock. So this could be a good long-term investment for you to keep those investment accounts alive, keep those in the investment accounts in that company stock. And then over the long term, as long as that company does well and that stock does well, you could have another pile of money that is taxed as a taxable investment account that would be different from your 401ks or IRAs or Roth IRAs. And if they pay a good dividend, you can even collect that dividend on a quarterly basis and maybe not have to sell the stock and have that be a supplement to your income in retirement. So that's taxable investment accounts as another as a way to create that tax diversification for you. So another part that I wanted to talk about today is asset location. So many of you that have done investing, you've probably heard of asset allocation. Asset allocation refers to what percentage you have in stocks, what percentage you have in bonds, and what percentage you have in cash. Asset location is what types of investments are you holding in your different types of accounts. So asset location is great from a tax efficiency standpoint. So what we just talked about was taxable accounts, right? So we talked about Warren Buffett and his large taxable accounts. Those are the types of investments that you want to hold in your taxable accounts are tax efficient investments. The reason being is you are taxed, those dividends that you're receiving, you're paying dividends, you're paying taxes on those dividends in that year that you receive the dividends. If you were to sell your stocks, you're paying either capital gains tax in the year that you sold those stocks. So what that means is in those taxable accounts, you want to hold your long-term investments. Long-term from an IRS standpoint is longer than 12 months because short-term, if you sold that stock on a short-term basis, you're paying ordinary income taxes on that stock. So tax efficient investments, when you look at your brokerage accounts, non-retirement accounts, you want to hold investments that provide a good dividend or pay good interest. And a couple examples of these would be, like I said, large blue chip stocks that pay maybe anywhere from a 3 to 5% dividend. Real estate investment trust, so REITs. REITs are great investments for taxable accounts because they also pay a higher level of dividend, and you would be getting that dividend income at a lower tax rate. Another great example is tax-exempt municipal bonds. So if you live in the state of Ohio, if you buy the state of Ohio municipal bonds, you can receive those dividends and that interest on a tax-free basis. So the interest you're receiving on a municipal bond would be tax-free to you. So those are great investments to have in a taxable account. Index funds is another example of this. The reason why index funds are on there is because they're not being actively traded. If you've owned mutual funds that are actively invested in the past, that fund manager is buying and selling stocks continuously. What that does is that can generate capital gains for you. And if he's held them for longer than a year, that would be capital gains that would be taxed as ordinary income tax levels. So index funds are another good investment to have in a taxable account because those aren't actively traded and they are held, those investments are held long-term and the money goes up and down as the index goes up and down. Switching gears to tax deferred accounts. So tax deferred accounts refer to your 401ks, your rollover or traditional IRAs, and your Roth IRAs. So what are some good types of investments to have in your tax deferred accounts? These would be investments that are more tax inefficient. The reason being, you are not taxed in that current year for any trades that you're making in those accounts. So for a Roth IRA, I always recommend that you want to have those investments more aggressively invested. The reason being that gets you the full advantage of a Roth IRA if you're not taxed on those gains that you have in the current year. So if you have a Roth IRA, that money grows, you can take that out completely tax-free. So here are some examples of investments that you'd want to have in your tax deferred account. There may be some fixed income, some alternative investments could be good, and actively managed mutual funds or actively managed strategies. So investments that may be traded, bought and sold very frequently because you're not paying taxes in that year. You're simply paying taxes when you take that money out, which for most people will be in retirement. So you're paying taxes when that money comes out and not in the current year that you have those. So again, this is another reason why investments like REITs or even high dividend paying stocks you could be getting those dividends and those distributions as income and taxed at a lower rate. But if they're in a tax deferred account, when you sell it, every dollar you take out of that account gets taxed at an ordinary income tax level. So very important, sit down, look at your portfolio and see how are your investments within each of these two types of accounts. How are they currently being invested? Again, if it's a new term for you, asset location. This is important to consider while you're preparing for retirement and when you're in retirement. So delaying Social Security. So another strategy that you could have is delaying Social Security. So for most of you, if you retire around the normal retirement age of anywhere from 62 to 65, you may not take if you delay your Social Security to full retirement age, which could be 66 in a couple months, or for people that are even younger than that, maybe it's 67. So you'll have a window in there where you'll be in a very low tax bracket. So if you delay your Social Security, if you retire at 62, delay your Social Security until age 67, that in those years, you'll be in a very low tax bracket. And that could be a good time to start taking withdrawals from your rollover IRAs or from your 401ks, because you'll be in a much lower tax bracket than once you start taking Social Security, or later on down the road at age 72, when you have to start taking a required minimum distribution. So at age 72, the IRS states that if you need the money or not, doesn't matter. You have to start taking withdrawals from those pre-tax accounts. A required minimum distribution could typically be anywhere from 4%, anywhere from 3.6 to 4% of the balance of those tax deferred accounts. So what that means is if you're retired and you have $1 million in your rollover IRA, you may have to take out $40,000 from that IRA, whether you need the money or not, so that the IRS can collect those tax dollars. So therefore, if you have a lower balance in those tax deferred accounts, your required minimum distribution could be lower, and in turn, that could keep you in a lower tax bracket, from the age of 72 until the rest of your life. So something to keep in mind as far as delaying Social Security and using some of those pre-tax dollars before you start to claim Social Security. So balancing income and taxes in retirement. As most of you are probably aware, you can claim Social Security at age 62. For most of you, full retirement benefits may be age 66 in a couple months, and maybe 2 months, 6 months, 10 months. But you can see these different amounts. And then at age 70, your Social Security benefit stops growing and it's capped at that level. But every year that you delay taking your Social Security, your benefit goes up by 8%. So you don't have to claim it at exactly one of these 3 ages. You can claim it anytime in between there. And every year that you wait, you get an 8% raise on your Social Security. Social Security, like I mentioned in the beginning of the call, at a maximum, only 85% of your benefit would be taxable to you. So this is a way that you could have some tax advantages by waiting and delaying your Social Security. It could lead to tax advantages because maybe only 50% of your benefit would be taxable, or at a most, only 85% of your benefit would be taxable. So this just gives you a demonstration on each year by year, if you were to delay taking your Social Security, what that does to your monthly benefit and how that benefit grows for you over time. So one of the last slides here is, and something to be aware of, it's a little bit creative and you may not have heard of this before, but if you have one takeaway from the call today, hopefully you learned about the 0% tax bracket. So what is the 0% tax bracket? So this is money that, as it says, you could potentially be paying 0 taxes on. So once you get into retirement, like I talked about before, it's great to have tax diversification. It's great to have an IRA that's pre-tax. It's great to have Roth IRA money, and it's great to have taxable investment account money. And it's because of the way that the tax brackets are structured. So one easy way to think of this, just to use hypothetical numbers, if you have your pre-tax IRA there and you can take on a tax-free basis, because of the standard deduction, if you're under 65, you can take $25,900 from your IRA and not pay taxes on that, right? Because that would fall below that standard deduction amount for income. If you're over 65, you get the additional $1,400 that you can take out from there. So you can, with your pre-tax accounts, you can start to maximize that number, that standard deduction number. So if you take out, call it $26,000 from your IRA, you would essentially not pay taxes on that. Next source of income that we talked about is Social Security. So if your Social Security benefit is $3,000 a month, so let's say that that's $36,000. So what that would give you, again, is another, $36,000 that would be tax-free to you. And only 50% of that Social Security would be considered for taxes. So 50% of that $36,000 is $18,000. So if you look at how the tax brackets are set up, $18,000 falls below this $20,000. So therefore, you could essentially have the just under $26,000 from your IRA plus your Social Security amount and still be in that 0% tax bracket. So potentially not pay any taxes on that. So that's one way that you can get a little over $60,000 in retirement and still remain in that 0% tax bracket. So if you're looking at, how much money you should potentially have saved in your IRA, this is where, maybe taking IRA distributions before you reach your required minimum distribution age starts to make sense. Because in the back of your mind, how much money should I take out from the IRA? Try to stay below that $25,900 amount. Or if you're over the age of 65, you get that additional $1,400 that you can take out. But if you take out that amount, plus you add your Social Security, you would be you'd pay, almost zero to very little in taxes at all. The other benefit that you would have too, the other, what I would call 0% tax bracket, is if you stay below, as a married couple, if you stay below $83,350 from your total income, and you have stock that is highly appreciated, so maybe you have very large gains in stock. So let's say, as an example, you own P&G, which a lot of Cincinnati people do. Maybe you inherited that P&G stock, or if you worked at P&G and you've got a lot of shares of P&G. So let's say you have $200,000 in P&G and the cost basis on that is $100,000. So you've got potentially a $100,000 gain in your P&G stock. Well, if your income falls below this $83,000 amount, you could essentially sell off about $80,000 worth of your P&G stock and still pay 0% in your capital gains rate on that. So kind of a unique strategy to think of when you're determining where to pull money from. And the other source of retirement income that I talked about was a Roth IRA. So let's say you pulled out $25,900 from your pre-tax IRA. You got your Social Security money as well on top of that. You don't want to get bumped up into a higher tax bracket. What you could then do is take money out of your Roth IRA, and your Roth IRA avoids any of this taxation. So it does not fall into that income tax level. You could start to take that money out of your Roth IRA and still remain in that very, very low, some would say 0 tax bracket by taking money out of your Roth IRA. So something to consider, staying in that 0% tax bracket. There's additional resources. If you have more questions on that, I'm happy to share that with you. But this is a way, by having pre-tax 401k and IRA money, Roth IRA money, and taxable investment accounts, that you could essentially be in the 0% tax bracket in retirement. Simple case study. So Steve and Jennifer, as you can see, they have different invested assets. So they've got about 700,000 in 401k balance. They've got about 400,000 in Roth IRAs, and then about 300,000 in taxable brokerage accounts. So what they are able to do, and then an estimated Social Security amount of about $3,700 if they wait until the age of 70. So by delaying Social Security till the age of 70, instead of taking it at full retirement age, they get an additional $10,800 every single month. So this is a good setup to see, okay, if you've got the money saved and you can delay Social Security, you get that increased annual benefit of $10,800 every month. And with these different buckets of money, they can withdraw from here and essentially pay very little in taxes all throughout their retirement. So, you know, having your assets invested in these different buckets can lead to, you know, a great retirement outcomes. And as you can see here, they reach their savings goal and they have their Social Security income as well. So this is kind of a case study of target amounts that you should potentially or could potentially have saved up. All right, so that wraps up the remainder of the call here. If you've got additional questions, feel free to send me an email. You can call my office line there. The number's on the screen, or feel free to visit my website. On my website, there's a link to my calendar where we can set up a quick consultation with 30 minutes to an hour, and we can talk through your situation if you do have more questions. So I appreciate you joining the call today. Hopefully you learned something. Like I said, this is recorded, so I can email this out to you if you have additional questions, or if you'd like to schedule time, please let me know. Thanks, everybody.